For decades, the textbook method for auditing a corporate treasury was straightforward. Evaluating a bank's signatory meant confirming physical evidence, a process designed for manual record-keeping. Financial verification relied on the permanence of ink. Authorization was a physical act, stamped onto a page and stored in a central file. This procedure required auditors to manually review physical check counterfoils, confirming that every outgoing payment bore the signature of an authorized individual. Auditors then cross-referenced those signed checks against internal board resolutions, ensuring the names on the paper matched the specific mandates approved by the company's leadership. Later, the profession added a layer of human resources verification, checking if the company sent timely notices to the bank whenever a signatory resigned or terminated. However, as physical checks become a relic, the distance between these internal paper trails and the bank's digital reality continues to grow. Auditing internal documents confirms what the organization intends to happen, but it provides no visibility into what the banking partner is actually executing. A company's internal records can perfectly align with an auditor's checklist, even while the organization's accounts remain exposed to external manipulation. By focusing strictly on internal board resolutions, the audit misses changes made directly at the banking tier, actions that leave no trace in the company's local filing system. This creates a critical question. What happens to the capital if the bank acts on a mandate that the internal executive team never authorized? A forged resolution can be submitted directly to a bank, bypassing internal legal review and adding an unauthorized name to the active signatory list. When an audit program stops at the edge of the company's internal files, it becomes blind to the operational reality of the bank's live environment. This gap in visibility allows for the ghost signatory, a user secretly granted access at the bank level without any corresponding entry in the company's books. Comparing the internal list against the bank's file reveals a discrepancy. The company authorized 2 notes, but the bank reveals a third user. Provisioned within the bank, this ghost signatory operates independently. It remains dormant for years, bypassing audits, until it activates, moving funds undetected. To address this, modern auditors must obtain independent, direct confirmation of all active users, pulled straight from the banking portal. Verification must center on the bank's actual permission state, rather than relying on the company's recorded intentions. In the digital environment, the signature has been replaced by the bank user ID. This shift requires auditors to track the total volume of administrator and user IDs issued to the company. The focus then moves to confirming that the authorized executives are the individuals actually logging into these active accounts. As banking mandates become entirely digital, the point of highest risk moves from the physical document to the management of access credentials. Effective credential management has become the primary financial control, superseding the role once held by physical signature verification. Within this framework, a specific operational threat arises, often referred to as delegation fraud. This occurs when an executive, such as a CFO, hands over their physical security tokens, login credentials, or one-time passwords to a junior staff member. This practice is usually adopted to increase processing speed or to handle the daily volume of payments more efficiently. Even when used for efficiency, a security token active on a junior clerk's desk creates a live digital connection that bypasses the intended executive oversight. If a fraudulent transaction is initiated using these delegated credentials, the banking system sees it as a fully authorized executive action. The digital trail of the transaction traces back from the bank's server, through the CFO's credentials, to the junior employee's machine. The bank's logs do not recognize the junior clerk. They attribute the action squarely to the CFO's unique ID. By delegating their digital identity, the executive assumes full professional and legal liability for every action taken under their name. The system's forensic logs provide a clear attribution of fraud to the credential holder, turning a workflow convenience into a profound professional risk. Protecting the treasury in this environment requires testing a specific set of digital controls that can be verified immediately. The first control is the implementation of device-specific authorization for all financial access points. This ensures bank IDs are locked to the specific physical hardware assigned to the authorized executive. This mechanism, known as MAC address binding, prevents the executive's credentials from being used on any other laptop or workstation. The second control involves identity verification that moves beyond a static password. Non-transferable multi-factor authentication ensures that the authorization requires a secondary physical action that cannot be easily delegated to a third party. These controls ensure that both the specific machine and the physical individual are identified before a transaction can be processed. A final layer of security is necessary to protect the entire authorization architecture from external penetration. This involves the strict application of corporate IP network restrictions. All Treasury login sessions are geofenced to the internal corporate network, ensuring that access is only possible from within the company's infrastructure. If credentials or tokens are compromised off-site, these restrictions block the attempt, as the login would originate from an unauthorized external IP address. These three technological controls, MAC binding, strict multi-factor authentication, and IP geofencing, provide active verification that a traditional paper audit cannot replicate. Maintaining audit independence requires direct evaluation of configurations inside the bank's own system portals. The mandate for the modern auditor is clear: stop auditing paper and start auditing the portal. Protecting organizational capital today depends on the auditor's ability to verify the digital permissions actually in force on the bank's servers.